China, the world's second biggest economy, seems to be collapsing. For a while now, there have been fears of a meltdown of the Chinese economy and its banking system, in large because of the collapse of the housing bubble. And if that happens, the impact won't be felt in the country alone, but the entire world. Ever since China joined the World Trade Organization in 2001, its economy has become increasingly integrated with the rest of the world. China's economy has grown so much that it has become the center of the global trading system and could even overtake the US by 2030. Also, the share of China in the world exports quadrupled from 4% in 2001 to 15% in 2021, while that of the US declined. Yet, as a result of the lockdowns, the Chinese economy is expected to grow slower in 2022 and 2023. As a matter of fact, the International Monetary Fund cut China's 2022 GDP growth projection from 4.4% in April to 3.3% in the July 2022 outlook. But the lockdowns are not the only reason for China's impending collapse. The foundation of China's current problems began during the 2008 global financial crisis, when the Chinese government gave large-scale stimulus to react to the global slowdown. The government gave banks instructions to give out to credits like there's no tomorrow, which resulted in a sharp jump in bank credit in 2008. However, the bulk of the credit was focused on real estate and property, which led to a rise in prices. The real estate and property sector account for as much as 30% of China's GDP, and it has eventually been crippled by the government's recent campaign to rein in reckless borrowing and curb speculative trading. You see, Chinese citizens love real estate. Owning a home is synonymous with security for retirement, and owning dozens of them, when you are able to get an affordable mortgage, is a top dog move to make. At least it was. Evergrande, one of China's largest builders, is a real estate empire with millions of apartments in hundreds of cities across China. It also has more than 300 billion in financial obligations, hundreds of unfinished residential buildings, and upset suppliers who have shut down construction sites. In its glory days, Evergrande rode China's epic real estate boom that urbanized large areas of the country. It grew so much that nearly 3/4 of household wealth was tied up in housing. This put the company at the center of power in an economy that began to rely on the real estate market for supercharged economic growth. With the success of the company and its many connections, banks and creditors had the confidence to keep lending the company money to grow and expand. And in the end, the company ended up with more debt than it could pay off. The company was knee-deep in problems and debts that it had to pay its overdue bills with unfinished properties and even ask employees to lend it money. It faced lawsuits from home buyers who are still waiting for the completion of apartments they paid for. Meanwhile, suppliers and creditors are claiming hundreds of billions of dollars in outstanding bills. Because of its financial ineptitude, Evergrande kept the financial markets on edge as it narrowly missed default payments on its bonds. And the Chinese government is insistent on cracking down on the reckless borrowing habits of developers. And it looks like they want to make the company a scapegoat. Currently, the real estate developer has over 800 projects across China that are unfinished, and as many as 1.6 million people are still waiting to move into the homes they paid for. Over the years, foreign investors and creditors have had the confidence to give the company money because they believe the Chinese government would always step in and de-escalate the situation. But because of the government's recent resolution to rein in on China's unsustainable debt problem, it looks like Evergrande will not get a bailout. Unfortunately, Evergrande's failure has also affected the economy. With home buyers and investors panicking, the fear has spilled over into the real estate market and hit prices. It has also shaken global financial markets and made it difficult for other Chinese companies to finance their businesses with foreign investment. But that's just part of the problem. Because of China's real estate bubble, thousands of would-be homeowners have pushed for a movement to stop paying mortgages on their incomplete homes just so they can put pressure on Chinese Communist Party and banks to treat them fairly. However, Evergrande and the failing real estate sector are not the only factors that are causing China's impending collapse. The banks are also threatening the economy as they have borrowed at high rates to fund property developers and attract the deposits from citizens by offering high interest rates. But since April, banks had to shut down withdrawals to prevent bankruptcy and a bank run, which usually leads to panic. Sadly, that was inevitable, as thousands of people stormed banks to protest after being unable to access or withdraw their life savings. It was then discovered after a fraud investigation that the head of the parent company of the banks had been on the run from the law enforcement authorities. The fraudster was reported to have carted off billions of dollars, and now the government is refusing to return the $6 billion that have disappeared from the bank deposits. It's no longer safe to keep cash in the banks, even the big state-owned banks. And now, it's likely that China is heading toward a complete collapse of its financial systems. Due to mortgage crisis, Chinese banks are dealing with a risk of over $9 trillion in loans. And if the situation worsens, this could lead to the economic collapse of China. Coupled with the bank deposit scams, real estate, and the mortgage situation has affected millions of households in the country, it seems like this colossal crisis could be much worse than the 2008 financial crisis. So far, the Chinese government has refused to release more monetary stimulus until inflation and the pandemic are under control. Future will tell how well China can handle an economic punch of such magnitude. Thank you so much for joining in on this episode of On Finance. I'm Ray. Make sure you check out all of our social media. I'll see you later.